Why the USD is historically low and its implications on business. The US dollar, USD, often considered the world's reserve currency, plays a central role in global finance and trade. However, in recent times, the USD has experienced a notable depreciation against a basket of major global currencies. This decline marks a significant shift with far-reaching consequences for businesses around the world. Why is the USD historically low? Several interlinked economic and geopolitical factors are contributing to the weakening of the US dollar. 1. Interest rate differentials. The US Federal Reserve has paused or slowed its rate hikes, while other central banks, e.g., the European Central Bank and the Bank of England, have maintained or even raised interest rates. Higher rates abroad attract capital away from the US, weakening the dollar. 2. Fiscal deficits and government debt. The US government is running large fiscal deficits, and national debt has surpassed $34 trillion. Investors may be losing confidence in the long-term value of the USD due to concerns over debt sustainability. 3. Geopolitical shifts and de-dollarization. Countries such as China, Russia, and members of the BRICS alliance are pushing for trade in non-USD currencies. This movement toward de-dollarization reduces global demand for the dollar. 4. Trade imbalances. The US consistently runs trade deficits, importing more than it exports. This creates sustained downward pressure on the dollar as more USD flows out to pay for foreign goods. 5. Inflation and purchasing power. Although US inflation has cooled, it remains elevated compared to pre-pandemic levels. Inflation erodes purchasing power and can diminish investor interest in holding USD-denominated assets. Implications on business. A weaker US dollar has complex and sometimes contradictory effects on different sectors and regions. 1. Positive impacts. Small blue diamond exporters benefit. US goods and services become more competitively priced abroad, boosting demand and helping exporters like Boeing, Caterpillar, and agricultural producers. Small blue diamond tourism and education gain. Foreign tourists and international students find it cheaper to visit or study in the US, helping sectors like hospitality, travel, and higher education. Small blue diamond multinationals with overseas revenue win. Companies earning significant revenue in stronger foreign currencies, e.g. Apple, Microsoft, see higher returns when profits are converted back into USD. 2. Negative impacts. Small orange diamond importers face rising costs. Businesses that rely on imported goods or raw materials, e.g. electronics retailers, manufacturers, see costs increase, squeezing profit margins. Small orange diamond inflation pressure returns. Higher import prices can fuel domestic inflation, especially in energy and food sectors, leading to reduced consumer purchasing power. Small orange diamond emerging markets face instability. Many emerging market businesses and governments borrow in USD. A weak dollar can ease repayment burdens, but the volatility itself may cause capital outflows and uncertainty. Strategic business responses. Hedging currency risk. Use financial instruments to protect against further currency fluctuations. Diversifying supply chains. Reduce dependency on dollar-linked imports. Localizing production. Manufacture closer to end markets to avoid currency mismatch. Dynamic pricing strategies. Adjust pricing models in response to cost swings from currency volatility. Conclusion. The historically low USD reflects broader global shifts in economics, trade, and geopolitical power. While it creates opportunities for some businesses, it poses challenges for others. Navigating this environment requires proactive currency risk management, operational flexibility, and a global mindset. Companies that adapt quickly will be best positioned to thrive in this new monetary landscape.